I think what we should do is probably have a quick, 2-minute chat about the market. And then I want to get James and I talking a little bit about, general how to take risk and what it feels like at market bottoms and what it feels like at market tops. Because, James's experience and my experience is probably the most valuable thing right now. And for those who don't know, what are we doing? Let me just share my screen. So overnight, the market got a very good result on Nvidia earnings, and it popped overnight and then completely reversed all those gains in the market hours. Once the market opened, it was like straight down, went down through every other level that it's traded at, and now everyone who's bought the stock, this is the stock market, by the way, everyone who's bought since about September is underwater. In the context of this bull market, that's pretty unequivocally bad. It's like it's bad, and crypto got dragged down as well. From my point of view, there's a couple of things that I'll talk about after James about the crypto DAT trade, the MicroStrategy trade. But James, in general, how do you feel about taking risk here when the market seems to sort of grind lower every day?
I think the same way that I feel about taking risk before the market started grinding lower, sort of generally. I mean, I think you're sort of rewarded overall for taking risk and holding it. I certainly wouldn't panic out of any sort of risk positions you might have in stocks or Bitcoin or something like that. I would probably be nervous if I held a whole bag of trash, right? Because that's, like if we're talking crypto, some stuff we know is going to zero eventually. We know it trends a lot on the downside. I probably wouldn't be too happy holding a big bag of absolute dog shit.
Ian,
But
looking
if I
at
was,
you.
if I were in, if you're in SPY and you've got like, a strategic long in Bitcoin and things like that, I think the only real thing to worry about is that everything's just moving a lot more now. Not compared to like kind of ridiculous things like March 2020 and stuff like that, but whereas we were sort of moving like this before, now we're kind of moving like that. So the way I would deal with it is just trimming positions a bit. Like a $1,000 position used to move like a little bit. $1,000 position now is kind of acting like it's sort of twice as big, right? So the thing that I would do, and that sort of I always do, is just cut some size when things start moving a lot. And that's not really a position, like that's not really a view on the market. I'm not going, well, I think this stuff is going to go down, so I'm going to cut some size. I'm just going, well, I'm taking more risk than I used to. My positions are effectively bigger than they used to be, and I sized them to a position that I was happy with, and now they're bigger. So my approach, if I've got strategic longs that I don't have any real view about direction, because I'm an idiot, right? I don't know whether Bitcoin's going up or down or sideways or in circles, right? So I would likely just cut that position a little bit. And then, when things calm down, I'd probably add to it.
That's great advice. And one thing I'd add is that I know I'm thinking like a retard whenever I go, do I get in or do I sell my position? I'm
Mhm.
already in retard land because I can do halvesies. And
Yeah.
if you're not sure about whether or not you should sell a position or keep it, nearly always an appropriate thing to do is halvesies. Like
Mm.
that's that's actually kind of a good, halvesies is halvesies, quartersies, somewhere between, I would be trimming somewhere between what, 25% and 50%, depending on what you're holding.
I think that's totally reasonable. And I think it's a good idea because like there's so many so I was trading around, the GFC 2007, 2008, that kind of time. And like a lot of people got kind of screwed because they sort of stopped themselves out of that market because they were scared. They had stock market positions or whatever, and they stopped themselves out because they were scared. And then it was emotionally really hard for them to get back in the market. Right. And they missed out on this kind of massive run. I think if they'd instead just sort of trimmed their positions to half the size, it would have been much less sort of emotionally hard for them to get back. Well, I mean, they never left, right? So it's much hard. It would be much easier for them to add those positions and scale up than it is sort of emotionally to get back in the market and start taking risk again. So I think it's a really good idea to stop thinking of things in a binary kind of way and think of them in a more continuous way, where you're going, hey, look, it's a bit riskier now. I'm just gonna trim some size. I'm not gonna stop myself out, like, holding stocks, probably holding Bitcoin long term will be a sort of positive expectation thing where you're almost, you're relatively certain to make money, certainly in stocks, maybe less so in Bitcoin, but I,
And
I would probably say,
as a general thing, when people hate crypto and hate stocks, you're closer to the time to buy than the time to sell, right?
yes, yeah. So, after an insane panic, and by the way, I think we're nowhere near panic land right
Yeah,
now,
yeah.
right? Like, we've just gone down a bit, right? But when we have an insane panic, when people are hitting bids and selling like just out of need, right? Because they need to make margin calls, they need to sell assets. They've got risk managers yelling at them and stuff. When the blood is really in the water, that's the time when you need money, right? Because your opportunities are enormous at that point. And that might be active trading, but it might actually just be getting a big meaty risk position on in the stuff that is good, like Retardio isn't good, Bitcoin is good, SPY is good. Those kind of risk positions, when everyone has panicked and everything is crazy, have higher sort of expected returns than when they didn't. So it's really important to keep your money for those points, which is why I recommend just cutting size, right? Because you'll lose some money, but you have more of it. At least you can take some risk.
It's an interesting thing in crypto because altcoins had this sort of forced deleveraging event a month ago.
Yeah.
And so there's relatively a lot of selling in Bitcoin because a lot of the holders are involved in the stock market, but relatively
Yeah.
little selling anymore in altcoins, um, especially the smaller alts. Um, so to me, the crypto market looks like it wants to find a bottom, but the stock market is just dragging it down. And if the global risk appetite, we can't pretend that crypto
Mm.
is not just a higher risk version of tech stocks, right? Like that's how it trades. That's what it is. It's just something that
Yeah.
people buy when they feel good and comfortable and they feel like placing a few speculative bets. Yeah, so I mean, we can't pretend that we're not in danger here. And I think James's advice is good advice. I'm going to talk some more about the DAT trade after James, but James has got a FinRev update for us, and he's going to show you an incredible trade that you guys can do. That's like fucking cool. That we're
Yeah.
in,
Should I
that we're
should I do
that we're incorporating in Hypertrend. Then yeah, she screen.
should I
I'm
do
excited.
that? Thank
You'll
you.
love this,
Thank
Ian.
you for
This is one of the
thank you
dopest
for
trades
that.
you'll ever see.
Okay. Can you see my screen? It should say dirty pairs trading. So I'm gonna show you a trade which has sort of worked in stocks for a long time, and is based on a very simple idea. Um, and I think you can. Well, the reason I've called it dirty pairs trading is I think that you can do it by hand in crypto without any of the kind of usual smarts and coding and math and stuff that you need to do this kind of trade. So I'm going to show you how, like, as a complete sort of dickhead degenerate, you could do the same kind of trades that we're putting in Hypertrend's TLP vault. And they're all kind of, it's based around a really, really simple idea. And all of our trades really are based around a really simple idea, right? Trend is based on an incredibly simple idea. Harnessing funding is based on an incredibly simple idea. And pairs trading or mean reversion trades or statistical arbitrage or whatever we want to call it is based on a core fundamental idea that stuff that's basically the same and has the same kind of sensitivities and risks is going to tend to move together. And that means that if we're tracking the price of one thing and another thing that is the same, tracking the relative price of those things, and one of them significantly outperforms the other, there's two reasons that that could be true. One is that something important's happened, right? There's been some news or some information that causes us to believe that one of them has a better outlook than the other, right? So if we're looking at, I don't know, asset A and asset B, let's call it for, keeping it simple. If some news comes out that is positive to asset A and, neutral to asset B, then we would expect asset A to outperform asset B because that's just an incorporation of some new stuff that we know in
And
the
an
price.
example of this happened last week in a pair that you're looking at, Uni and Sushi, who are the
Yeah.
same basic thing. They're both DEX swaps, but Uni announced that they're going to increase fees and start making money instead of making zero money. And so that's the perfect example of it. Like these things were almost exactly identical. One was a copy paste of the code base. They're both old. They both trade on the same places, and then one announced that all of a sudden we're going to start making a profit and the other isn't.
Yeah, exactly. And that's the main thing that drives big price changes. If we see a big price change or a kind of repricing of something, it's because there's been some information or there's been like an earnings report or some kind of news or, SPF did something stupid. There's genuine information driving big price changes usually. But another thing that can happen is just that someone comes and they need to get a lot of size done or something like that. Someone needs to buy a lot of some token, some stock, whatever it is. And that's kind of technical, right? Where just a sort of supply demand imbalance, i.e., more sort of buying than selling or more selling than buying, can distort prices. There's no real sort of information associated with that, and that's what I'm calling technical. So I'm saying if we've got price changing because something has fundamentally changed, then that's a genuine mispricing. If we get price changing because someone just wanted to buy a lot of it, or they were stuck in a position, or they got liquidated, or something like that, there's no information about Uni or Sushi associated with that. It's just someone getting liquidated out of their position. It's a kind of technical effect. Now, pairs trading sort of relies on the fact that technical, if something has if the prices of two things have diverged, on average, the technical thing happens more often. Right? Absent any sort of really obvious news. So pairs trading is a simple thing where we go, well, hey, look, if it's a technical reason, it's likely to revert. Right? So it's a simple trade. It goes, knowing that and knowing that on average that thing is slightly more likely than the other thing, we can do a trade where we track the prices of two things, track their relative performance, and if they get out, we're going to long the one that's underperformed and we're going to short the one that's overperformed. And then we're going to hold it and we're going to wait for some convergence and then we're going to get out of that trade. So this is sort of a picture which illustrates that. We have two assets. Let's call them Uni and Sushi because that was a good example. They're sort of similar things. They're literally, Sushi was literally a fork of Uniswap, right? So, they are doing the same kind of thing, subject to the same kind of sensitivities and risks and stuff. So we might get their prices, we might sort of normalize them to be the same at the start, and we might track the relative prices of Uni and Sushi. Now let's pretend asset A is Sushi. just for the sake of it. Now, most of the time, these things are going to kind of move together. But let's say some sort of idiot whale came into the market for whatever reason and just sort of blew through the available liquidity, just taking out orders, pushing prices, maybe a TWAP that went on forever, right? And what that's going to do, the market doesn't have unlimited ability to absorb pressure from continuous buying and continuous selling. So anyone that's on the other side of that trade of that whale trying to buy is going to kind of move their prices up, right? And the result of that is that price of sushi is going to go up a lot relative to uni. So we've got aggressive buying that sort of just overwhelmed price and it's moved it up. Now, if that was all it was, right? If the only thing that really happened was some whale needed to get a lot of size done, then nothing has fundamentally changed. Nothing's changed between the kind of whatever business model uni and sushi has. So we would expect some reversion. That we would expect that to, if we push price up for no reason, we kind of expect price to come down for no reason. Yeah? And that's the basic idea of pairs trading, that on average we're trying to catch these kind of technical things. We're trying to catch liquidations. We're trying to catch big, stupid buying that kind of pushes price away.
Or a
And
stop loss.
or a stop loss, yeah, stop loss is being triggered, that kind of stuff, yeah. Those kind of technical trading things that have nothing to do with what a thing should be valued at, right? And I know valuation is kind of a tricky concept in crypto because it's all snake oil, right? But this is the idea, right? Like if a whole bunch of people get liquidated and price goes down, well, it's likely to come back up, right? Because the reason it went down is simply a bunch of triggering of stops, not anything that anyone cares
Your
about.
first job in professional trading, like for a bank, was actually doing this, right? Completely
Not for a bank,
unscientifically,
for
right?
for myself, yeah. So in a partnership, we basically found futures contracts that were basically the same kind of thing, like the same stock index future, um, or stock index futures in the same country but slightly different compositions and things like that. Um, different types of commodities, different sort of similar government bonds, that kind of stuff. We find things that are sort of almost the same, but sort of volatile enough that they move a bit differently. And then the idea is when they move significantly differently, you sort of take the bet on, which is like squeezing that dislocation out of the market. So in this case, if we're pretending this guy is sushi, right, and this has happened, we would get short sushi and we would get long Uniswap. Okay. And then we would wait for them to converge and then we would close out that position. And if the sort of opposite happened, right, if we find ourselves down here, we would be getting long sushi down here and we would be getting short Uniswap. We'd be waiting for some kind of convergence and we'd come out of it. So
So
it's a very simple trade.
to clarify, the big advantage of this sort of trading is that you're not taking any of this sort of underlying market risk that Trump's going to open his mouth, war's going to break out, like any of that stuff. The market should, in theory, if the whole market goes down, you're short. You should be neutral to the market-ish. Is that right?
Yeah,
Or
exactly right. Yeah, because you're long a thing that is subject to Trump doing something stupid. You're short a thing that is subject to Trump doing stupid. So you've kind of dirtily got rid of that general exposure to the market and news that affects both things. Because remember, what we're doing here is we're trying to find two things that are basically the same. So random things that happen that affect price should affect both of them in a similar way. Okay. The things that affect them differently are either technical things like liquidations and big buys and TWAPs and unlocks and stuff like that, or it's news that applies to one of them but not the other, such as the thing that Scott talked about with the raising of fees. Now, this isn't quite as easy as I'm representing it in my pictures, like most things are not, because it's very unlikely that the things are actually kind of basically the same. You know, Scott gave us that example, right? Like uni and sushi are kind of similar, but they also have the ability to change their business models and fuck things up and like change and, change their prospects in such a way that would actually motivate a real repricing. So what we always want to happen is if this goes up here, it's just some way or buying a load of stuff and it's likely to revert. But what can actually happen is exactly the example. We're going up here. The reason that this guy has significantly performed this guy is for some genuine reason, like the changing of their fee structure or something like that. In that case, we wouldn't expect the reversion of it coming down and trading like this because it would be a genuine shift in the fair pricing of those assets. So
So
when
an
we're doing,
example of that would be if you were trying to pairs trade hyperliquid against GMX, which is another perp
mm,
dex. You could say that GMX is losing market share. They're probably going to go broke eventually, and hyperliquid is gaining market share and it's making more money than any other crypto, and that would be a poor candidate for doing this kind of
yeah,
thing.
great example. You sort of want boring stuff that
Boring stuff.
that isn't subject to like hype cycles and stuff like that to do
And
the
this is
trade.
important concept from James. The ideal pairs to do this on are boring pairs. You should be looking at dead coins from the 2021 bull run that are still listed on every exchange. You should be listed on dead forks of looking at dead forks of things like fucking
Yeah.
BSV, like a dead fork. You
Yeah.
know, you,
I don't know if I've lost Scott or I've lost myself.
No, you're
It's-
still here.
okay,
James, Scott's just
cool.
intermittent.
He's on Thai internet.
sorry.
So because we know that this can happen, we need to design our pairs trading approach so that this can happen and we can still trade, right? Because if we decided that this happened and we ended up short this thing and long this thing and this sort of drifted off, we would lose money and we would never get out of that position. So we need to understand that things aren't the same and that real things can change the relative fair pricing between the two things in our pair. So we can't assume this, right? We can't assume that uni and sushi are actually genuinely the same thing, and the spread should just wiggle around in a range. And if it goes above the red line, we would sell the spread, and if it goes below the green line, we should buy the spread. And when I say sell the spread, I mean sell the expensive. Sorry, I mean buy the expensive one, sell the. Sorry, no, I mean, I mean sell the first one and buy the second one. When I say buy the spread, I mean buy the first one and sell the second one. I have probably confused you with that. I have some pictures and some diagrams of what I actually mean. So bear with me whilst I fumble over my words. So we can't assume this, right? We can't assume that the kind of ratio of two prices are going to sort of be the same, because if we did, when sort of bad news happened and this thing come, or good news for one of them and bad news for the other one maybe, then if we come out of that range, we're going to be stuck along that spread and it's going to go down here and we're never going to sort of trade and we're just going to be stuck in a position forever. So we can't assume this. We need to do a sort of more dynamic thing because we need to understand that things aren't actually the same and we need to build our trading so that it's sort of robust to that. So instead of sort of assuming we're right, we kind of assume that we're wrong. We assume that things can happen. We assume news can happen, stuff can happen. And we might do something really simple like use Bollinger Bands or something on the spread, the ratio between asset A and asset B prices, and allow what we think the kind of reasonable value of the spread to be defined by something like a moving average. And if it goes significantly above that moving average, we would sell the spread. And if it goes significantly below the moving average, we would buy the spread. Now we're kind of adaptive, right? So if news happens, we don't need to know why. We don't need to know why this happened. We can still say, well, hey, look, relative to the past history of the relative prices of these assets, this now looks cheap, so I would get long. This now looks expensive, so we would get short. Okay. Now, a really simple way to do this is to just get the prices of two things and take the ratio of them. So take the price of one thing, divide it by the price of the other thing, um, and plot that. Stick it in trading view, plot it, stick some Bollinger Bands on it, probably 2 standard deviation Bollinger Bands, something like that, and then plot the price. So this blue line would be the moving average. This red line would be the top 2 standard deviation Bollinger Band. The green line would be the bottom standard deviation Bollinger Band. And whenever the actual price sticks its head out above one of the bands, we kind of donk it back down. So if it goes up here, we would open a short on the spread, which would mean we'd be selling the more expensive, start selling the first one, buying the second one in whatever our ratio was. And then when it came back and it crossed over the moving average, we would say, hey, look, now it's fairly priced. And we would close out that position. So we're going, hey, look, when it pokes its head up here, it's now expensive. When it crosses over the blue line, the moving average, we say, well, it's fairly priced. And there's no point us having a position in a spread that we think is fairly priced. If it pops out below, we would get long the spread, so we would long the first one and short the second one in the pair. And again, when it crosses the moving average, we would close it out. And we would just keep doing that for as long as we were happy that that pair still had some kind of fundamental relationship. And as long as we were happy, we were still making money. If we were trading this thing and we'd just been losing money for 6 months, we'd probably stop doing it. So to be clear, when I say long, if we've got a spread that is, say, uni sushi, let's call A uni and B sushi, then if we're getting long the spread, we're buying uni and we're selling sushi. And if we're getting short the spread, we're selling uni and we're buying sushi.
How do you calculate the ratios for those? Do you just do an equal weight, or is
Yeah,
there
I
any
would.
advantage?
Yeah. For this example, I'm just saying, hey, look, just take the price and divide the uni price divide the uni price by the sushi price. And that's sort of based on the assumption that if you're doing this, these things are roughly the same thing. They have roughly the same kind of market exposure. And I'll kind of talk at the end about how we're doing something slightly different in the hypertrend TLP vault. But for the purposes of this kind of approach is more than good enough if you're doing it by hand.
So
But
you wouldn't just do $1,000 each, $1,000 long, $1,000 short. You would do the ratio of the uni price divided by the sushi price.
no, I would literally do the same dollar value
Oh, the same dollar
in
value.
each
Perfect.
one.
Perfect.
So
That's perfect.
if we're getting, say we're getting long here, we're buying $1,000 of uni and selling a
Gotcha.
$1,000 of sushi. And then when we're getting out, we're doing, whatever it takes to get out of the position, because of course it kind of changes.
And that's because even though we should technically be doing something more complicated, residualizing them and figuring out their volatility, in the real world, uni and sushi are the same basic thing. They move the same basic way. They're,
Yeah. And like if you're doing this by hand, you
for,
just want it to
we,
be as simple as possible, right? Like you just want to be able
yeah.
to do it in trading view without worrying about it and just comb through a bunch of pairs and see how it does.
And that's 80% of the way there, right? Like I
Yeah,
don't see any
absolutely.
particular advantage for getting all mathy with it.
No, no, and this is a perfect segue into my next slide. Thank you, Scott, which is that, this is a sort of almost like a, a toy example of how to do this, but that doesn't mean that it's not valuable. It doesn't mean that you won't make money doing that, because the actual effect we're trying to harness here is itself really simple. We find two things that are basically the same, and either they're going to noisily sort of diverge and converge in such a way that we can make money, or they're not. Right? So no amount of like running regressions and fancy maths and stuff is going to make a pair of assets diverge and converge repeatedly in a noisy way more than trading costs, such that we can make money. So doing this kind of simple approach is more than reasonable, in my opinion. The sort of thing that you need to do is to find two things that are genuinely very similar and genuinely sort of volatile enough that we can trade them and have shown a history of making money trading it like that in the past. Right? So these are the kind of three things, criteria that I can tell you for having done this quite a lot, which will help you find the best pairs. Like the first one is find two things that are basically the same. You know, they're in the same kind of world. They have set this similar kind of structural things about them. They are likely to be similarly sensitive to news and things like that. And you can do this in a statistical way, but I suggest you do it in a vibes-based way, like we've just shown here, going, hey, look, uni and sushi are basically kind of the same thing, doing the same kind of stuff. Let's see if that
GMX and
works.
drift.
Yeah,
Um,
that kind of stuff. Yeah, that kind of thing.
yeah, if you're in the chat right now and you got any random ideas for shit like that that might work, just toss them in the chat. Um,
Yeah. Yeah, it's kind of fun. Like I'll show you how you can just sort of set this stuff up and test the stuff out. So the first thing is to just find using vibes or asking a friend or whatever, find some things that are basically the same and likely to move together. The second is to actually plot that ratio of prices. Divide the uni price by the sushi price. I'll show you how to do that in TradingView and plot the spread and look just how much it moves. Is it kind of moving within like a sort of 10% range? You can probably trade it pretty well, right? Is it moving within a 1% range? Well, you've probably got no chance of actually making money trading that. So, your second thing is to go, well, actually, is the spread itself volatile and wiggly enough that I can make money? The third thing is that stuff that does well now tends to be stuff that also did well in the past. And this is kind of dumb, but it is true. I've done like tons and tons of analysis on this, where I got a bunch of stocks and I kind of I think I took the Russell 1000 universe and I created pairs based on every single combination of those things because I was interested in asking the question, what is a good pair to trade? And by far the most predictive thing is if doing a pairs trade on the pair made money in the recent past, it's more likely to make money in the future. So this is why you kind of want to run some kind of simple finger in the air simulation. I'll show you how to do it in TradingView to go, hey, look, did doing a pairs trade on uni and sushi make money recently? If it did, it's more likely to be a good trade going forward. What that also means is if you're in a pair and it's been losing money for a long time, you probably want to stop trading. So I will show you, we'll run through an example. I'll show you exactly how to go through those three steps, and I'll show you exactly how to trade. Um, I will just finish this up by saying that this used to work really well in stocks, but it works even better in crypto. The reason that is that stocks are more efficient now, right, than they were when people were doing this kind of thing a lot. But crucially, like, there's not much leverage available in stocks. Remember that in this trade, we are long one thing and short a very similar thing, which just means that it doesn't move very much. You've taken all of the market exposure out of it, which means if it doesn't move very much, it's hard to make much money trading it. But the good news is we have access to perps through dodgy bucket shop perp exchanges, and they will happily let you hang yourself with leverage, right? So you can take way bigger positions in these long short positions. The other advantage in crypto is it's just a less efficient market, right? It's more it's highly fragmented. You've got people doing sort of very obvious TWAPs. You've got people fat fingering stuff. You've got people pulling liquidity. You've got liquidation cascades. You've got all of these technical things that can cause exactly the kind of effects that we're looking for. So I'm going to go through an example trade and I'll show you how you can do the same thing. So it's basically sort of a 3-point process to find a pair to trade, and then the act of trading it is very, very simple. So step one is find two things that are basically the same. Step two is I fuck the spread and make sure it's wiggly enough that you can actually trade it profitably. Step three is to do a simple back test to see if trading it would have made money in the past. And I will tell you that if, regardless of how good you think your idea is about two things that are basically the same, if you run a back test and it wouldn't have made much money, then forget it. Like if it didn't work, if it's never worked, but you thought it should do and it's a good idea, scrap it. It wasn't a good idea. Market says not good idea. And by far the most predictive thing for this kind of stuff is would it have made money if I'd done it recently? Now, if you have a pair, so Union Sushi is a good example, that actually works quite well. If it's good, then we trade it. And our trading is really simple. You know, we if the price crosses below our Bollinger Band, we open the spread long, which just means that we buy X dollars of asset A and we sell X dollars of asset B. If the opposite happens, if it goes above the Bollinger Band, we do the opposite. Right? We open a short spread, which is buying asset X dollars of asset B and selling X dollars of asset A. Then we just sit in that until the price crosses over the moving average. I'll show you some pictures, the blue line in my pictures. And when it does, we just close the position, come out of it, and then we wait for one of these two criteria to be true again. So it's a very simple process. Step one is probably the most important, which is find two things that do similar things. Now, when we're doing this at scale and hypertrend in the TLP vault, we're mostly doing this through categorizing stuff, but through statistical methods, because we're looking at loads of stuff, right? And we're kind of looking to see statistically what stuff is kind of the same, as well as vibes-based, what does this thing do? I suggest that you completely ignore the statistical thing. If you're doing this and you're trading a few pairs by hand, you don't need to get heavy-handed with it, and do it entirely vibes based. So if you don't know what things might be similar, ask someone who does. Talk in this chat, talk on the Discords or whatever the thing that we've got is, or ask the AI. Right, ask a friend, ask the AI, or go on one of those sort of websites that categorizes things into sectors or something like that. So I did one of these things and Scott did the other. So I asked Scott and he asked the AI, and we came up with a bunch of ideas of stuff that might be decent pairs traders. And we're going to look at spreading.
And I've traded these before, and I did it. I did it before by the simple expedient of asking our friend WC what he trades. And he gave me his list. And I just checked his list just now. 1-inch Ave, Ave Comp, Send, Mana, and Balancer 1-inch. And they're all fucking great.
Yeah. So we're going to look at Balancer 1-inch in this,
sure.
which are both do sort of DEX, AMM aggregation type stuff. That's sort of it, right? We go, hey, look, these two things are kind of the same, right? They're sort of the same. They're in the same kind of area. So let's go and have a look at the spread. So in this, we're doing Balancer 1-inch. So we go into TradingView, we type Balancer divided by 1-inch in there. And that's just going to show us the ratio of those prices. We then stick a Bollinger Band indicator on. Now, because I wanted to show you some action, I've done a relatively short Bollinger Band window where I've selected my length of my Bollinger Band to be 1 day. We're looking at 96 15-minute bars, and I've set my standard deviation, which controls the width of these bands, to 2. And that's a sensible default for this kind of stuff. Set your standard deviation to 2. If you want to trade slower than this, which I would recommend, I'm showing you this fast because it makes my story and my pictures a bit more exciting. But if you want to trade slower than that, just increase the length of this window here. Then what we're interested in is, how wide is the gap between the top of the band and the bottom of the band, or the top of the band and the middle. So in a good trade, what we're doing is we're getting in over here at the top of the band, and we're coming out of it somewhere near the middle of the band here. So we're basically, a good trade that goes well is expected to yield us about half of the average width of the band here. And you can
When you
see,
exit, James, when you exit, do you exit a little bit past the mid band, or do you?
so the thing that would trigger, exiting is having observed it cross over the mid band.
Gotcha.
Well, your actual exit is either going to be better or worse than that, right? Because you observe it crossing the mid band, then you've got to place the trade. And in the time between you observing that and placing the trade, it's either gone up or it's either gone down, right? So you're going to sort of win on some of them and lose on others of them. But here we go, look, we have like about a 10% wide band here, which means that a successful trade is going to yield us about 5%. Not all of our trades are going to be successful. We might say 60, 70% of them might be successful. But this is kind of wide enough for two liquid things that if this is realistically a very good trade, we might make some money. We would like this to be 10%. We would like this to be 10% rather than 5%. And if we increase the length of it and look for slightly more volatile things, maybe it should be. But for what is an intraday trade here, this is kind of wide enough that if we're good at doing it and it's a good trade, we would expect to make some money from this. So we would say we've passed sort of number 2. Number 3 is we do a kind of dirty back test on whether actually trading this pair in the manner that we talked about would have made money. And there's a trading view strategy which you can get from sort of pressing the indicators button on here and just searching for RW simple pairs trade. So this is a community strategy that I made a while ago in a previous life, which you can add to your chart along with the Bollinger Bands that you added when you were eyeballing the spread. And what that does is that simulates actually trading it. So you can see, here we came down below the Bollinger Band here, so we've entered long. You can see here we came above it, so we've closed out that position. And you can see here that effect that I was talking about, Scott, where we've entered here. So we've entered here after we crossed below this, and then we initially take a drawdown coming up here. Then we move, then we cross over the average, and we decide to get out, but we get out on the next 15-minute bar because we can't magically get out at the same point that we observed it. So you can see here we got out of that at a slightly better price than we intended to. But you'll also see that the opposite can happen as well. We can slip against that. So this is what you do. Do a dirty back test, stick this thing, RW simple pairs trade on it, set your parameters to exactly the same things as you set your Bollinger Bands to. So in this case, I've set my sort of window to 96 15-minute bars, which is a day, and I've set my Z score to 2. So set these things to exactly the same as you put it in your Bollinger Band, and then you will see a kind of backtest. And now this is a completely unrealistic backtest because it's not taking into account any trading cost or slippage or anything like that. But if this were not a good pair, we would expect it to either not make money or make money in a particularly noisy way. Yeah. In this case, we can see that we're very obviously going up to the right, that 82% of our pretend trades were profitable, and the profit factor on this, I don't even know what the profit factor is, the dollar value of successful trades divided by unsuccessful trades or something. I think it's something like that, is large, right? But the main thing to see is that it went up and to the right, and we made a bunch of money trading this spread. So now we've identified something that kind of makes sense. It was kind of the same. We looked at the spread and we saw it was wiggly enough that if we were good at it, we would make money. And we did a simulation and we saw that it did make money. So that's all of our three criteria sort of ticked off. Now the job is to trade it. Um, and trading it is real simple. We do exactly the same thing that we did. We put the Bollinger Bands on TradingView. In this case, we're doing 96 15-minute bars for our look back. And then we just kind of wait for price to poke its way out of the Bollinger Band. So in this case, the price of the pair, the price of the spread, poked its head out. So we would get short. And you can see here, we triggered here, we got short on the next bar. You don't have to wait 15 minutes to do this trade like the simulation does. Like you could have just put that on as soon as you can after you've observed that. Then we
You can
kind of
also
wait.
right click on the Bollinger Band and place an alarm. And that way you can have it in another window and you don't have to watch it like an idiot. It just goes bing, 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 bing when it's time to
And
look.
you can do it. Yeah, perfect. So then we got short. And how do we get short? Well, so our spread was, what we're plotting is balancer over 1 inch. I've written this in the most confusing way possible. In this case, we would be selling balancer and we would be buying 1 inch. And we would be buying exactly the same dollar value that we were selling. So we'd buy $1,000 at 1 inch, say, and sell $1,000 of balancer. Then we just wait. So what happens is it looks good, and then it goes over here, and then we're getting worried, right? Because it's gone against us and we're in the drawdown. But what has eventually happened is it's closed over the moving average. We waited a while and we got out here. So we were kind of relatively lucky on this one because we entered high, we shorted the spreads higher, and we sort of closed it lower, bought it lower than we intended. Right? Then we do nothing, right? Because like during this time, we're saying that this pair is relatively fairly valued. We're saying if it's within this band, it's reasonably priced. So we're not really going to enter a new position. But what happens over here is we cross below the Bollinger Band, and then we take a long once we've seen it cross it like that. We wait again, it goes slightly against us to start with. Then it comes up, it crosses back over our line, and we close the position. And we close the position by doing the opposite of what we did, but with whatever quantity we entered. Right? So what we're doing when we open the position is we're buying $1,000 of balancer and selling $1,000 of 1 inch. Obviously, by the time it gets up here, balancer got more expensive than 1 inch, so we have slightly higher dollar value of balancer than we have 1 inch. But that doesn't matter. We just close whatever positions we have on in the sort of base units of the spread. Does that make sense? So that is the trade, and it is a simple one, and it is a good one, and it sort of depends on two main things, or three main things, really. It's like, have I found some stuff that's the same? Is the spread wiggly enough that I can make money on it? And if I tried to trade it in the past, would it look like it has made money? And you can do all of those things with some vibes and some AI help or some help from your friends and with TradingView. So I would suggest you try some things. So in that same kind of group of sort of AMM DEX kind of world, some things worth looking at are Uniswap and Sushi. So here's the kind of simulation of that. I think this guy is the thing that Scott was talking about changes in fee structure, most likely. We could try curve balancer, 1 inch balancer. So I would advise you to have some fun with this, go and try some stuff, try some other sectors. Maybe ask the AI for certain candidates. There's
Manna
no
and
shame in
Sand.
doing. Oh, Mana and Sand. God, I used to trade all that crap.
They're
Yeah,
they're both dead. They're both dead Web3 gaming projects.
yeah, I
Um,
remember. Yeah,
um, are
I
they
guess the
one
one.
inch?
I guess the one thing is you probably want to prefer something a bit more liquid than that stuff. So if you're looking at sort of dead gaming projects, then when you're at step two, look at the spread and make sure you can make money. You want a really wide spread if you're trading like a liquid crap. For like uni sushi, that's or whatever this was, Balancer, what was it, Balancer 1 inch. This stuff is relatively liquid, but if you're trading absolute dead stuff, you want to see a pretty enormous spread on this stuff. But this is fun, right? Like and this is this is a good trade that people do. It's a trade that we do in TLP, but we do it a bit more automated and larger scale. Um, but it's very simple. You just find something that's basically the same, you plot the spread, you backtest it. If all of those things look good, then you do a very simple trade that, anyone can do if they're in front of the screen and they have time to do it. And the process of finding this stuff is pretty fun. Oh. So go and do this stuff and play with it.
Yeah,
Um,
you're going to learn more from taking $1,000 and taking $500 trades than you are from studying this endlessly or trying to figure out the math. It's
yeah,
one of those things that there's a significant expertise in the actual move the mouse and click and orders in, and there's expertise in that. It's the kind of thing that a home trader like you guys could grind out a living, like day after day after day after day. You've got your pairs, and you look like our friend WC does this all day, every day. He's got like
yeah,
half a dozen pairs that he looks at. He's got little alarms set up. His computer goes bing, bing, bing. He hears it from out in the kitchen when he's playing with his kid. He walks in, he places a trade, and he sits in front of the computer for half an hour and shit talks on Twitter while he waits for it to close, and then he goes on with his day.
yeah.
These
It's a
are
good
basically
trade
trades
setting.
lasting a couple of hours. Do you want to cover the bit about you should puke if shit doesn't go your way pretty quick?
Yes, yeah. So I will come to that in a sec. I just wanted, for the sake of anyone who wanted to do this, to just go through what you do in TradingView very quickly. Um, which is that when you have the pair, you plot it by essentially doing the first one divided by the second one. Just put this slash in here. Then you add the BB Bollinger Band indicator with an appropriate length and a standard deviation of 2. 96 15-minute bars is going to keep you entertained because those are trades that like kind of last a few hours, right? You can also do it slower. It doesn't quite work as well if you're doing it slower, but is much more robust to your trading costs. So you plot the spread, you add the Bollinger Band indicator, you add the RW simple pairs trade strategy to TradingView, then you set the parameters to exactly the same as you set to your Bollinger Band, so 96 15-minute bars, Z score of 2. You check whether it worked in a back test, and you're most interested in whether it worked recently, right? If it made money in the last 3 months, you're probably interested in it. You're less interested in what it did 2 years ago or something like that. Then to actually trade it, you're just buying or selling the same dollar amount of each thing when it crosses outside of the Bollinger Band, and you're closing the position when it crosses over the middle. So very simple. Um, we do something very similar, but significantly more complex in the Hypertrend TLP vault. Um, One of the sort of main things is we never, like in the Hypertrend portfolio, we never have the concept of like entries and exits. Um, if you're a retail trader in front of a screen, you kind of need to have the concepts of entries and exits, or you're going to be very confused about what you're doing and what positions you have on. But our stuff is all automated, and there's no reason for us to restrict ourselves to that. So instead of opening a spread and closing it at certain points, we would just be more long the spread the further below the mean we are, and more short the spread the further above the mean. So basically, we're always got positions in most stuff. We just might have smaller or bigger positions on at any point. So if my example here, we would kind of be pretty long the spread here. We would get slightly less long. We would get more long, the further away below the Bollinger Band we are here. We get less long here. Over here, we'd kind of be max short. At this kind of middle band, we would have no position on. So we kind of trade continuously rather than taking entries and exits. We do that because we can, and we have like cost optimizations and things like that in. You very much don't want to take that approach because it will cost you too much money. You'll pay too many trading fees doing that kind of stuff. The other thing we do, which Scott alluded to earlier, is we decay our signal, by which I mean that if we got in a position, say we took it went below the Bollinger Band, we got long the spread, then, it's been 24 hours and the spread hasn't done anything. It hasn't converged, it hasn't moved in our direction. That would cause us to be much less certain that our thesis was right. And our thesis in always in this stuff is nothing important happened. It was just a liquidation or a big sell or something like that. Right? So if the longer it hasn't converged, let me go back to my original. The longer this hasn't happened, if this has happened and we haven't seen any real convergence and it's been 24 hours or 48 hours or something, it's way more likely we're in this scenario where something important has changed the relative pricing between the assets than we're in this scenario between which is some idiot just bid it up and then it's going to revert.
So in practical terms, after what, 4, 6, 8 hours, if it hasn't done what you thought it was going to do, you puke?
Yeah.
Or
Yeah. So that's what I would consider doing. If you're trading this kind of stuff, so you look back of a day or whatever, if you've got to like 4, 6 hours and it hasn't really done anything, probably about 6, I would go.
6.
If it hasn't done anything interesting, just puke it, right? Just get rid of it. It becomes less likely to work the longer that you're in it and it hasn't done what you wanted, because the probability of it actually being some real thing you don't know about has increased at that point. The other thing we do in hypertrend is we calculate lots of signals. So I just showed you how to take the ratio of prices and calculate this sort of distance from the Bollinger Band, which is called the Z-score, if you're a math nerd. We'd have a whole bunch of pairwise signals that we calculate that aren't just that. They're not particularly complicated, but there are lots of them. We also normalize for market risks. So where we took the example of balancer and 1 inch, we just divided their prices by each other. That kind of assumes that they have the same kind of market exposure and they're as volatile as each other and they move as much as each other. Sometimes we'll find the case where we've got two things that are sort of the same and they have similar kind of sensitivities, but one of them is kind of considered more risky or younger or more uncertain than the other, and therefore it tends to move a lot more and be more sensitive to general risk in the market. So it probably moves more. It's more volatile, right? So what we do in hypertrend in that case, if we like a pair, but one's still moving a lot more than the other, we'll create pairs where we might have our pair might be say $1,000 of asset A and $600 of asset B. Yeah? So we're kind of neutralizing the market exposure. I don't recommend you do that because the best pairs are basically similar. Like the best stuff that you can find is going to be basically the same thing. So I don't think you need to worry about that stuff. The other thing we do in hypertrend is we don't actually trade the pairs like I've shown you. We basically calculate features on the pairs and then we sort of smash them all down into predictions we flatten them out basically into predictions for each coin or each perp. And that allows us to then throw it in with our other features like trend momentum, trade aggression, stuff like that. It's worth saying that this is way more complicated but it's fundamentally doing the same thing that I've just shown you and recommend you do, which is just tracking the relative prices between stuff. And when one of it pops its head up versus the other one, you sort of take a big hammer and you donk it down. You know, we're doing it in a more complicated way because we are going to be trading lots of money. We need to be very mindful of costs, and we also need to trade it in a portfolio which includes other things. So we do all this complicated thing to basically do the same thing that I'm advising you to do, but we do it because we have to, because we're trading lots of money, and we also do it because we have a team of nerds that can do this stuff. You do not have a team of nerds, so this simple trade that I've shown you will be good for you. You'll be trading relatively small, and you will make money if you do it well. So, quick recap of the trade in case you weren't paying attention. Find stuff that's basically the same, stick the ratio of the prices on TradingView and stick some Bollinger Bands on them, and make sure it moves. Make sure the width of those Bollinger Bands is a sensible enough number that you could make money. You would love the width of those Bollinger Bands to be 20% so that, an expected return from a good trade would be about 10%. But in the example, and that's probably what you'd need for some trash, right? In the example we showed of some slightly liquid stuff, we got an expected return on a good trade of about 5%. That will make money if you trade it carefully and if it's a good pair. Then do a back test on it, put on the RW simple pairs trade indicator, have a look at whether it made money in the last 3 months. Ideally it made money for the entire back test. But if it made money in 3 months, it's quite likely to make the last 3 months, it's quite likely to make money going forward. Then do the trade and ideally do some other trades as well. Each pair is not going to make money. You are going to find a pair and it's going to stop making money. That is guaranteed. That's going to happen. So the more pairs that you can manage trading at the same time, the better. And your trade's just very simple. Do what Scott said, plot the Bollinger Band, set some alerts. If it goes ding, stop whatever you're doing and go and put the trade on. And the trade's very simple. You put the same dollar amount long as you put on short. If it's below the Bollinger Band, you buy the first one and sell the second one. If it's above, you sell the first one and buy the second one. Then when it goes and crosses over the moving average, you sell it. You just quit the position, get out of it. Then you do nothing, set the alert, wait for it to pop up above or below your Bollinger Bands, and then close it when it crosses the moving average. So I think this is a fun trade. I think it's a good trade. I think you'll have fun finding pairs, looking at them, seeing if they make money. I think you do need to be slightly careful that you're not making that, it doesn't cost you too much to trade to get into them. If you've got a bid-ask spread on something of 1% and your expected return from a good trade is only 4%, then you're probably not going to make any money. So just be mindful that if you've got liquid stuff, you want your spread to be really volatile. You want it to be moving around all over the place if you've got a chance of making money.
This is amazing, James. This is
Thank
a
you.
trade that you can make a living off. In fact, James has made a living off this trade. A bunch of people we know make a living off this trade. We know people in TradFi, lots of them, who basically do variations of this trade sitting in a seat all day for a fucking job, right?
Yeah, I think as far as I know, there are still people that spread futures, which is just this trade, successfully at relatively large scale, like in sort of commodities and index futures and fixed income and stuff. And it's it's nowhere near as
does
good.
this for Tudor. He does this all day. That's all he does. It's got a Sharpe
Yeah,
ratio of 3 with $600 million. I mean,
is that right? Wow. Yeah.
yeah.
Yes, I don't think it's quite the so when I was doing this, we had this tool called TT Auto Spreader where you could just sort of load in the spread that you wanted to trade and set your parameters and it would just leg into the spread for you and do it. And that was at the time like embarrassingly easy. So this would have been back sort of just after the GFC, I was doing this kind of stuff. Oh no, sorry, just before. And at the time, it was really easy. It got sort of more competitive, and we went into murkier and shittier markets. And now I'm talking about it in crypto, right? One of the shittiest markets we can find. So, this kind of thing is a good idea. It's worked in most sort of markets. It's worked in futures. It's worked in equities, and I think it works well in crypto. And I don't think you need to overthink it, right? Find something that makes sense. Make sure the spread's volatile enough. Backtest it, then Leroy Jenkins in and, maybe trade 4 or 5 pairs at the same time if you can.
And if there's sufficient demand for it, we'll spin up a group for this. I know I've got a bunch of friends who trade this like as a job.
Hmm. Yeah, if you've got
We'll
some, if
get
you've got
sort
some
of live
time
thing
and you're in,
happening. But I mean, sorry, you first, James.
oh, sorry. Yeah, if you've got the time because you're in front of the screen and you can do it, this is one of the more sensible things you could be doing with that time. Like it's a well-worn path.
Yeah, you're gonna be able to grind out a living, and the big advantage of it is you're not sensitive to the market moving. So right now, my butthole is puckered super tight because I'm worrying, is the market going to keep crashing? But you
Hmm.
don't have to worry about that because, like, you long one, you short one. If one goes down, one goes up, because the market, if they both go down, it's a relative thing. So it doesn't really, you can forget about the overall predicting the overall wiggles and twists and turns of the market, which is a
Yeah.
huge advantage. It just takes the stress out of it. You just got a job. You turn up to your job, you do your job. You don't give a fuck if it's going up or it's going down. You make money either way. I mean, that's a
Yeah.
nice place to be for a home trader. I bet Ian wishes he was in that fucking place today, right?
Yeah, that would be very cozy.
Yeah. Oh, you're comfy
Yeah,
in
so
spot.
you'd probably be doing well in the, like recently I suspect this kind of stuff would be doing well, right?
Yeah.
Because everything's moving all over the place and people are overreacting to stuff and stops are being triggered and liquidations are happening. Like it's the perfect kind of environment for this kind of stuff.
Okay, guys. James,
Sweet.
thank you so much for your time. Like
A
as always,
pleasure.
we appreciate your knowledge. For those who haven't seen James before, James is the guy who taught me how to trade. I really didn't know shit about fuck until I met James, and it turned out that all the things that I thought I knew about trading, like 80% of them were wrong. And he had to very kindly and gently tell me, "Scott, you're a fuckwit," and but he didn't actually use that word, which was very kind of him.
I
Um,
probably would now.
Stop drawing those fucking lines on those fucking charts, you fuckwit. Key levels, support and resistance, none of that shit, none of the shit that I thought worked. It was
No,
all
you
wrong.
mostly draw dicks on charts
I
instead.
draw dicks on charts. It's highly effective. So I'm going to take over now. I'm going to talk a little bit about hypertrend and the airdrop and some more stuff. But what I want to talk about is, and James, don't feel free that don't feel like you have to stick around if you don't want to.
Okay,
Our big
I'm
bet
gonna disappear and get on with some work. Thanks, everyone. I'll see you
You're
soon.
welcome. Thank you so much, James. Our big bet in hypertrend is on the hyperliquid ecosystem. So one of the things that we want to check, both for our hyperliquid trade, um, we want to look at the hype price. So let's quickly look at the hype price. You can see in all the recent hyperliquid is behaving like a beach ball down, and say Bitcoin is going down. You can see Bitcoin's going down today because the rest of the market's going down. Hyperliquid's not. So this is the daily average users is growing. The market share compared to centralized exchanges has turned up and growing again. The revenue is stable at $3.5 million a day, which in what is pretty much a bear market phase is really good. So what that tells us is that, that's annualized $1.3 billion a year worth of revenue, which is all going to buybacks. This is the new users that it's adding. So you can see this is the token generation event. They added a lot of new users. And then you can see that even though the market's been going down, we're still adding, 3,000 new users, 3,000-ish new users a day. This is on on the left side, and that's broadly speaking wiggling but trending up. So the danger here, from my point of view, is that there's a bunch of these MicroStrategy trade guys, and if they start selling their coins, the market will mechanically trade lower. Every day I ask ChatGPT any further news or rumors of DApp selling, which is actually a really, really useful way to use ChatGPT. I use it for a lot of research kind of stuff like this, and I recommend getting a ChatGPT or one of the other subscriptions. So every day I check this. I could have it running as an agent, and overnight we've got an Ethereum seller sold 20% of their stack. They sold, and there's some, Chinese KuCoin breaking news about it, and there's a BTC DAT who are selling. So what we're seeing is the small social media firms selling. So far, the big MicroStrategy copycats aren't selling. And we want to look at how much extra flow are we talking about. It matters at the margin on ETH, but there's no sign that the flagship treasuries. So the ones that I'm looking at are MicroStrategy, MetaPlanet, MicroStrategy, if anything, just down. So this is something that I keep an eye on. If that happens, we're probably going to continue to trade lower. The other thing I want to look at is the stock market, because this looked really bad overnight. No one is going to want to take risks with a daily candle like this. I think we've probably got at least one more of these. I think we're in the range of a stock market bottom, maybe not there, right? And so that translates to Bitcoin. Actually, let's look at it at alts. Let's look at total 3, which is so you can see this is a slow, boring grind down. What we want to see to get involved is a capitulation. So this was a capitulation. Hopefully we don't get anything like that, and it would be hard to get anything like that because we've already had a capitulation. But we're looking for a sharp move down before we start to get involved. When we see a sharp move down, what we should see, if it's the right move down, is a very violent move back up. You can see how the move back up here was super violent. That's what we're looking for. We're looking for these things to start levitating and leaving people behind and making, because everyone's too scared to buy alts right now. We want alts running away. We want the bus leaving empty. So this is an old trader theme, that the bus leaves empty. I'm going to talk a little bit about our hypertrend program and our airdrop here. I'm going to run quickly through it because some of you have seen it before. If you have, feel free to jump off. What I'm going to show you here is fully automated. It's set and forget. It's created 4,000. It's actually more than that in gross percentage. It pays the highest passive income out of any asset you'll ever own. Let me introduce myself. You all know me. I'm Scott Phillips. I've been trading for 20 years. I wasn't very good for the first sort of, I think, about 8 years or so. It kind of sucked, maybe 10. I trained under some billionaire traders, but honestly, none of them are as good as the guy that you just saw, who really taught me everything useful that I know and taught me the math behind it. And I've made pretty good money. I've achieved my lifetime financial goals from trading crypto. I'm worth over 8 figures, comfortably over 8 figures. And I got that from doing all the stuff that we talk about on here and the automated system I'm about to show you. And it's been good to me. It's been a horrible, hateful, shitty thing to do. And it's caused me significant stress and lots of mental illness. And it made me rich. So I don't know. So here's some, screenshots of shit that I did in the past. We bought some, tiny altcoins like Cock Inu before they were popular. Another one called Retardio, which I round tripped. I am a gorilla-sized person, and yes, I bench press 5 plates. I bought Bitcoin when it was $4.21, and then I sold it when it was $21. Like I've made some terrible financial decisions. In the last bull run, I turned 40K into 770K by the time we cashed it out, and I did 5K to 1.3 million with a side account as like a challenge thing. Um, this fills me with so much anxiety, this screenshot, because I took $100,000 in profits that day instead of $500,000, and the whole thing's worth about 20 grand now. It's not something to brag about. I totally round trip that. So this opportunity I'm going to show you isn't like that. So it isn't like one of those like you've got to pick the time right, or be good, or know the right coin, or be an experienced trader, or have a lot of money stored up to take advantage of. There's no barriers to entry. The pie is large enough that everyone watching us can get their fair share. Because one of the main strategies here is to gun for a massive airdrop, there's not as much risk involved. Like airdrops are, yeah, airdrops are a good thing. So one of the reasons I'm excited about this new token and its airdrop is because I'm building it, James is building it, and we've got all of our own money in it. We're full stacking it. We're going to participate as heavily as we can. And I can tell you, no one's ever done anything like what we're doing. We're copying the play from the most exciting time, which is Hyperliquids, the most successful airdrop of all time. No need to rethink the wheel. We're here to get our community rich, our community bootstrap this project, and we're here to get ourselves rich. But we've made it so that the only way that all of our staff, Ian's involved, Caroline's involved, Paul's involved, Maurizio, all the coaches, we've all got all our money in this. And the only way that we can get any of it out is if we make you guys rich first. Which was a weird decision to make. I remember when I told the CFO that we were going to set this whole thing up so that the only path to us getting rich is making the customers rich too. And he was like, that's financially irresponsible. Like surely not. And we kind of burnt the boats. Like we made it so that we have to make everyone win if we're going to win. And I think that's the true ethos of crypto. We're all about generational wealth. No one gives a fuck about the tech. I don't care about the tech. I care about retiring my bloodline, and so should you. So how's this going to make you rich? Well, of course, there's the airdrop. It's free money, but that's just the start. It's what happens afterwards that's going to make you rich. You'll get the asset. So year it's 75%, but we think it's going to be about 50% per year and annualized in stable coins. And that's important because having a USD dollar denominated asset, you're not holding some shit coin that's going to go up or down, going to earn 50% on it. That's enough to live off. And that's cash in the bank. It's not some magic beans you got to steal to make money. You can get a stable coin denominated credit card hooking off that and do all your spending off that. That's what I do. I've got a Hyperbeat credit card, and you know, I mean, I live in Thailand, so I don't pay taxes anyway. But yeah. So at the very least, what I promise you is you're going to walk away from this presentation with a much better understanding of how to get a passive income and build retirement wealth from crypto. And I'm not talking about stupid shit like I'm not fucking 19. Like, don't do any of that stupid shit is my advice. I did it when I was 19 and I wish I hadn't. And I want all that money back. Buy a house. Don't be a fuckwit. For me, wealth has been debt-free, having enough money to live your same lifestyle, the lifestyle that you want, without having to work or without having to justify your time. The biggest flex for me is that my wife doesn't have to work. Having the freedom to do whatever the fuck you want with whoever you want, whenever you want, for as long as you want. If I want to take today off and just go walk my dog on the beach, I can do that. And this idea of personal freedom, do whatever the fuck you want and escape this kind of like declining sad age that we're in. This is the beating heart of crypto, and it's something that I've been able to achieve. It's something that you can have too. So how do people actually make big money in the crypto markets? Well, mostly the big money in crypto has been made from insider trading. VC rugs and scam coins and pumps and like all the grifty shit that we all hate. Just like Nancy Pelosi does in TradFi. Boy, I was so hateful about the Retardio thing. Boy, I really thought that was going to work. So I was in this group chat where the Retardio cabal, they called it, and they used to just come up with an idea for a coin, and the 50 or so people involved would all pump it together. And getting inside on that stuff early was hugely profitable. I paid for my kitchen with it. But you probably don't have that. It's not insider trading only works when there's idiots coming in to buy your bags, and it's not feasible. It's not feasible or sustainable, and you probably don't want to get involved in shit coins long term unless you really know what you're doing. You can still make plenty of money without being an insider. The second way that we've made a lot of money is by bringing over TradFi trading strategies. And the one you just saw today is a thing that James did for years and years and years as a job. He had an office that he rented. He'd turn up to his office every day with a fucking lunchbox and a takeaway cup of coffee, and he'd sit and click, 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 and make money. We've got this hedge fund buddy, Macrocephalopod. He runs $800 million now. He copy and pasted he told us how to do the trend following strategy that we do in Hypertrend. And he also he didn't quite tell us. He refused to tell us the pairs trading thing that James just told you, the more advanced version, but he gave us enough hints that we could figure it out on our own. And so these guys are making, 10 times the return at double the average hedge fund Sharpe ratios. And the low-hanging fruit in crypto is just taking things that worked in stocks and doing them on crypto. Like, that's all I've ever done. Like, since 2020, all I've ever done is take stock ideas and transfer them to crypto. So this is the biggest unfair advantage in the history of finance. It's the only one that's available to the little guy. And the most reliable, consistent one is what's called the law of momentum. And momentum is the statistical tendency of things that have gone up a lot to keep going up, and the tendency of things that have gone down a lot to keep going down. And we see this today, like Bitcoin, like shit that starts going down has a statistical tendency to keep going down. You're going to hear me use these terms, momentum and trend following, interchangeable. Trend following is the trader name for it. Momentum is the nerd name for it. They're the same thing. So what is the law of momentum? It's the trading strategy that can be used to predict which assets are going to go up noisily and weakly, and which assets are going to go down. So it's about the stronger the momentum, the bigger the price movement. It's like a body in motion stays in motion. It's a simple concept. Produced thousands of profitable trades for the biggest hedge funds in TradFi. It's worked for 137 years. It's as close to a law of gravity as we have. If there's things that I'm really, really certain about in financial markets that won't go away, I'm certain that people who take risk by putting their money in stocks will outperform leaving their money in a bank in the next 50 years. Maybe not in the next 10 years, but in the next 50 years. I'm certain that people who are selling insurance will continue to make money. And by insurance, I mean put options. Sorry, I'm going to turn my video off and on because I did that. If I hold my fingers up, Zoom doesn't like it. And I'm also certain that momentum and trend effects will continue to work, especially in crypto, because we've got no actual valuations we can point to. Like, it's all magic beans. It's all like a Fugazi made up. Like, what's this thing worth? Like, Sand is a Web3 gaming company. It's still worth $5 billion. Like, how the fuck do you come up with that number? It is what it is. So it's been profitable for 137 years. That's all you need to know. And there's like firms like Gun Capital, which have been going since 1970, which have, outperformed the S&P 500 enormously with a very low correlation to stocks. So this is kind of a nice thing because it works when stocks doesn't. And in crypto, we see the same thing. I've got my retirement accounts with these guys, and they've hit it out of the park for me. I'm extremely happy with Mulvaney Capital. They lost 34% this year. They made 150% the year before. it's a wild ride, but if you need TradFi trend exposure, this is the company that I recommend, and I use myself, and I know every person working there. I know their systems inside and out, and I love these guys. So this is an index, every trend following firm compared to the S&P 500, which is in grey. You can see that even though the S&P 500 has done really, really well, trend following has just kicked its ass. And fun fact, the first human city was in modern day Iraq, ancient Ur, in Mesopotamia, in Sumeria. And before they had money, they used to use barley as money, and they stored the prices. And it turns out that you can run trend following systems on that. And if any of you have seen the RTV patterns and retest patterns and the candlestick stuff that I do sometimes in the emails, this is all from 16th century Japanese rice futures traders, which was the first futures exchange in the world. They knew all about trend following, and it worked just as well then as it does today. So it's a thing that's been around. There's this guy who's one of the funniest guys on Twitter, Clifford Asness. He's made $1.6 billion from doing it. But he did a study of how well trend following worked every decade. And you can see that it had lots of losing years. Like it has like 3 losing years in 10 in TradFi. Doesn't in crypto, but on every decade since 1880, it's been profitable. And he says this is and worked annoyingly well for an idea that's so stupid. And what I'm trying to say is this is really as close to a law of gravity as we have, because it's worked in stocks, bonds, real estate, FX, commodities. If you're in Australia and you know that why are house prices going up? Because they've always fucking gone up, and because people are counting on what's happened in the past to continue happening in the future. And like I looked at Australian real estate and thought it was overvalued in 2012 and didn't want to buy. And here we are in 2020, nearly 2026, and it's still overvalued, and I still don't want to buy. And that's at the heart of the edge. It's worked for 10,000 years because human nature hasn't changed. I'm still dirty about Australian property. I'm still pissed off about it. Human psychology hasn't changed. I still fucking wish I hadn't sold my Bitcoins for $21. I'm still greedy. I'm rich now and I'm greedy. Greedier. I'm still fearful. Still don't want to lose all my money. Like all those things haven't changed. Now we've taken those street momentum bellows with crypto and they just work better. 2.5 to 3 times better, but everything works 2.5 to 3 times better. And crypto market is constantly growing. New money flows in from institutions. The president's completely on board. The markets are open 24/7, anonymous, tax avoidance, dirty Chinese and Russian money getting out. Like crypto is a black hole for all the dirty Russian and Chinese money in the world. And none of this stuff has any real valuation. So the price can go anywhere. They can go as high as you like or as low as they like. And so we've been applying momentum trades to the crypto markets, and we've done really well over time, like really well. We've done slightly worse than doubling your portfolio every year. It started out, but close. It's almost double your money every year. This would have turned a $10,000 starting investment into $481,500 today. And the good news, it's been profitable for the last 137 years. So you just need to let compounding do the work for you. It's one of those things that you just let run, and you don't think about it, and you don't second guess it, and you just let it run. If you start off with $10,000 and you know by year 5 you've got a really big stack, but you can see around the next bend, all you have to do is hold on and you've got that retirement income. And it sounds crazy, like it sounds hard to believe, but shit, that's what happened to me. Like I'm doing these like ordinary strategies, and then one day it was like there was multiple millions in the account, and then I had a really good year, and then you know the last 5 years in a row I've made over $1 million US doing this stuff, and it's slow. It's painful to do. We can speed up the process by taking some risky bets and pulling them back out. And so here's what we did to cut the time to generational wealth down in half. I got all my best trader buddies on board, like James, who you just, by the way, James is an astrophysicist with a PhD by trading. He used to work for BlackRock. Um, he left BlackRock. He has an identical twin brother who is also a quant for BlackRock. His identical twin brother now manages $30 billion for BlackRock, and he works with us. So he might have he might have taken a wrong turn career-wise, but he's every bit as smart as he was. We built our own algorithmic trading system that executes momentum trades in the crypto markets, and it's called FinRev. You might have heard me talking about it. It's generated insane returns for us, and most importantly, it's kept everyone safe while the market's been fucked. Like, it hasn't made or lost much money lately. It's made a little bit, but fuck, everyone else has been taken out and shot. Like, there's a value in that. It's beaten the returns of Bitcoin, ETH, and the best tech stocks. Quick vibe check, raise your hand if you think you'd be richer today if you'd invested in Bitcoin since 2019. Well, FinRev's consistently beaten the returns of Bitcoin. Sorry. But the big advantage of doing it this way is that you're not really exposed to the crashes. In almost every terrible, terrible bad day for crypto, we've done really well. Why? Because we're shorting the shit that goes down and buying the shit that goes up. If everything stops going up, we stop buying it and we start shorting it. So you avoid a significant amount of what you'd call the bullshit premium that comes with crypto, like the hateful days. Which means that if you've been using FinRev since the early days, you'd be richer today than if you invested in Bitcoin or tech stocks like NVIDIA. So what is FinRev? It's an automated trading system that trades using momentum algorithms, but applied to the crypto markets. And so based on the trading parameters we've given FinRev, I might just load it up in another window. It scans the blockchain looking for the strongest momentum trades. So what we do is we rank everything on how much it's been going up or going down. And let me just load it up and then I'll pull it across for you. I'll show you the trades we're taking right now. As soon as that loads. As soon as that loads, here we go. All right. So you can see on Binance today, we've got 3 coins only slightly positive. We've got ZEC. These are the coins that we're betting are going to go up, but almost everything else we're betting that it's going to go down. And overall, when we blend out, we have 3 different algorithms that we blend together to get it smoother and nicer. Mostly, you can see here, we're eyeballing it about 75% short. So if the market goes down today, like it looks almost certain to, we're almost certain to make money. Why? Because we're betting that almost all of these go down. If the market goes up a lot today, which I'm hoping, but it's not the way to bet, we'll probably lose a bit of money. And one of the things that's going to happen is that we're going to lose or make a lot less than someone just straight up gambling is going to do. So it's a stable, it's a sensible version. It all runs in the background while you get on with your life and you avoid all this bear market bullshit. That's the big advantage because it's not stuck to one position. You've got 50 positions open. And those positions flip to be betting that the market is going down pretty quickly. Like today, we're heavily exposed. We're heavily betting on the market continuing to go down. That is, even though I don't want to say it, the smart bet. And if I'm left to my own devices, I'm an eternal optimist. I made a lot of money being an optimist. I'm like, I love crypto. I think crypto's the future. I'm naturally biased towards optimistic. The algorithms don't care about my feelings. And this is a very, very useful break on me being a fuckwit. It stops me from being a fuckwit. It actually allows me to be a little bit of a fuckwit because I can take a few gambles. Like I've got still over $1 million worth of hype. that I can bet on turning into $10 million because of this. I could never take bets like that without this doing the necessary in the background. So we generated 10 million bucks for clients. We hold today about 18 million AUM. Yeah, there's a lot of people who have made a lot of money with it. And it's not like a shitty trading bot that requires you to constantly check in and monitor a stake. It's a professional, like this is the sort of thing you'd see in a hedge fund. And I check my accounts more than once a year, to be honest. But not more than once a month, really. I checked them about 2 weeks ago to make sure they made money when all the shit was going down, and they did. But yeah, all you do is deposit the funds you want FINREV to trade with and let it do its thing. Talk about it all day. Let me take a look at it now. One sec. All right. Let's take a look at. Sorry, I'm a bit clumsy with the mouse. So this is the last 30 days. Made 5% in the last 30 days, while everything else has been being fucked. Let's look at how the system actually works. Let's pick a coin. Let's pick, say, BTC. So Zoom slows this down a little bit. Basically, what we're doing is we're making a prediction of prices where it'll be obvious once this thing loads up. Come on, you slow bitch. Sorry about this. Here we go. Okay, so this is our forecast. If that forecast is positive, we're going to start betting that the thing is going to go up. We're going to trade about 50 different points so that any individual bet is not going to mess with us too much. And you can see from about here, we increased our positions up and then started banking profits until we have no position at all here. As the market started going up, we started increasing positions on here. And this has been kind of a shitty market for our system. So we haven't made any money on this lately, except about here, we started betting that the market was going to go down. And, we're positioned for the market going down. So right now in Bitcoin, we're balls short. If the market goes down, we're going to continue to make money. If the market goes up, we're going to lose money. And so we do this on average. And what happens is that most of the time, this doesn't do very well at all. But then you get a big bull run. And in a big bull run, like back here, you get long at the start and you basically stay mostly long all the way through right into the end. And so they have this saying in trend following that one good trend pays for them all. Actually, let me show you some. Let's look at. Let's look at. Pretty much the start of the. Let's look at a longer term view. So you can see it's done fuck all for the last, little bit. But over the last 2 years, it's made 154% on average for every client using the system. 154% in 2 years is pretty good by anyone's standard, but the actual reality of it is shit. Like on any given day, you're like hardly doing anything. And then you get a massive bull run, and we have the saying in trend following that one good trend pays for it all. So to put it all in perspective, I mean, this has been a disappointing year for crypto. We're still up 154% in 2 years. It's not that bad. It's like, when I go home for Christmas and they ask how's your crypto doing, I'm not going to be hiding about it. So, you can amass a big fortune doing this if you stay the course. You can't get these kind of returns anywhere outside of crypto, and this is how new millionaires have been minted. You could easily be one of them. In short, FINREV makes money on autopilot. You throw your funds into it and you trade and set and forget. You make even more money from FINREV. Let me ask you a question. Would you like to be an owner? Would you like to own part of the company? And what does that mean? How does being an owner make you even more money? Well, what we're doing is there's two ways being an owner makes you even more money. So in order to distribute ownership of FINREV with our community, we're turning the entire thing into a token. The token is called Trend Token. And presents a legal right, not just some sort of trust me bro thing. It's enshrined in a smart contract, a right to grab your share of 20% of all profits generated by the successor of FINREV called Hypertrend forever. And why would we give away our profits? It's the same reason why companies issue stocks. We're tokenizing the income stream. When you increase the size of the pie, everyone makes more money. And the truth is that if we have a coin that's owned by Ian, James, and I and the rest of the people in this company, it's not worth anything because everyone knows that any one of us sells it and we'll dump it. If we get our ownership out into 10,000 people, then it is worth something. In the same way that Dogecoin isn't worth anything, but it's actually worth a lot because the ownership is spread so widely. This is what we're trying to do. We're trying to spread the ownership widely. This is the real reason, not the bullshit marketing reason, is that any coin that we make is unsaleable until 5 or 10,000 people own it, and we'd rather you guys own it than anyone else. Yeah, I'd rather own a small slice of a big pie rather than 100% of a small pie that's going to dump whenever I sell it. Like, that's a stupid thing to do. And when we pay out 20% of profits to FINREV, it's essentially acting like a dividend stock. So we think we can earn $100 million a year for our members as our share of the profits. That's plus what you make. So we did 75% this year in our new Hypertrend algos on Hyperliquid, which are better than FINREV, actually. They're significantly better than FINREV. But we think we're going to average about 50% per year in USDC. And just like stocks, you not only make money from the profits shared out to owners of the token, you can make money when the value of the token goes up. And so what we're doing is we've invented a bunch of tokenomics, the rules of the way the token works, that are going to make the value of the token go up. We're going to artificially push it to the moon. We're just going to make the number go up. And how are we going to do that? We're going to use profits that we make. We get 20% of the profits we make for people who invest in Hypertrend. We're going to use that 20% of the profits to buy our own token. That buying is going to push the price up. We've set in motion a plan to launch FINREV's native token at a $100 million valuation. And we have a playbook to get this to be $1 billion coin. And the playbook it sounds fanciful, but it's not. If we have $1 billion in AUM, which we think we can easily get 700 million on Hyperliquid alone. We think $1 billion is realistic. We think we can earn 50% of that $1 billion a year for our customers and take 20% of that, which is $100 million for ourselves, and use that $100 million a year to give to Trend customers. If we're giving out $100 million a year, it's worth $1 billion. We're going to create $1 billion worth of value. And this coin has passive income component that spits out raw stable coin cash for anyone who owns the native token. So you get rich from the passive. So most tokens, like you can buy Aptos, stake Aptos, and you get Aptos coins. But Aptos is a fucking magic bean. No one wants that. No one wants to be paid in magic beans. Everyone wants to be paid in cash. So we're doing the thing that's never been done, which is an altcoin which pays in USDC. So you can just collect the passive income from it. The passive income generates more demand for the coin, which drives the coin price up, making you even richer if you choose to be an owner. So the three legs, you get rich from FINREV trading from you get rich from the passive income you earn, you get rich from the price of the token goes up. And our ultimate goal is to build an asset that you don't have to sell. You don't have to time the top market. You can hold through a bear market. It's generating a USD stablecoin return in perpetuity. You hook up a USD denominated a stablecoin credit card to it, and you do your spending off that, and you just live your life based on that forever. This is my plan. This is what I want, and so I built it for everyone. And it's a coin that never has to be sold. Because it spits out raw cash every month. It's an asset you can stack. As long as it's stacking USDC for me, I'm totally happy to hold it. What I'm not happy to do is hold like I held Retardio, which did Retardio. I bought Retardio here. I sold a little bit here, and I sold a little bit here. Sold about 100 grand worth total. Bought 2,000. This became 500,000. I took a screenshot instead of profit. And now, where are we? Right back where we started. Round tripped it all. So I don't want to go through that again, and that's what this is for. So to achieve this, we've tokenized FINREV's entire algorithm into a coin called Trend, and I believe this is the path to wealth for everyone watching this right now. This is a winner, guys. This is a winner. When we're giving away initially 32 million in airdrop to our members, and we're gonna run it at 20 vol. 2.3 sharp, which is a bit over 50% a year. I think it's comfortably going to be 50% a year. It easily has the potential to be $1 billion coin. We bought the ticker right. It's listed on Hyperliquid. Let me explain how it works. So Trend is FINREV's native token. If you've heard about Trend before, there's been some developments. The way that we force the price of the coin to go up is by building in mechanisms that generate more demand for Trend. So basically, we incentivize people to hold Trend and not sell. More demand for the token means the price of the coin goes up. And as profits are generated, we're using profits to buy Trend token on the open market. So let me show you the way we call it number go up tokenomics. So in the real world, revenue generated by the protocol gets paid directly to the token holders. This creates demand for the native coin without being inflation. So we're not printing new Trend tokens. There's only 100 million Trend tokens, just like there's 100 million Bitcoin, just like there's 21 million Bitcoin. You want passive income paid in USDC, you buy the Trend coin. FINREV already has 20 million AUM. It generates real world revenues. It automatically creates demand for Trend because holding the coin generates passive income for holders. So when people from the general crypto market buy Trend for a share of the profits, the price goes up. There's always been a demand for assets that generate passive income we're seeing crypto move towards a real yield kind of meta where people want actual things that make money and not just bullshit promises and pumps and dumps. So this is one piece. And most tokens pay out in their own token. But what happens is no one, you stake Aptos, you get Aptos tokens. No one wants Aptos. So they sell their tokens immediately. And this causes the price to go down. Reverse moon. Our token pays in USDC, so you don't have to sell. So paying out in our own USDC, paying out rewards in USD stablecoins is an amazing idea. Arguably, completely illegal until Trump got in. So the only reason where they're going to be the first to do this is because it was illegal until Trump changed the rules. So You buy trend, trend pays out yield in USDC to holders, no trend token emissions, therefore no sell pressure. The price of the trend continues to go up because there's more buyers than sellers. It creates a flywheel where people are incentivized to hold their trend instead of selling, which makes the price go up. The more the price goes up, the more people are interested, the less people are likely to sell. The momentum effect that we've already talked about. This is essentially why Bitcoin is worth so much today, because no one wants to be the guy who sold their Bitcoin for $21 like I did. No one wants to be that. So the supply is fixed at 100 million tokens. We can't generate more. Let me show you how you can prove that to yourself. So this is our coin at $58 million market cap, and you can look at the contract by going to Hyperliquid and looking at the contract, and you'll see the maximum supply is 100 million coins. Total supply, circulating supply, and the market cap right now is 58 million. We'll easily have that at 100 million by launch. Don't go buy it today. Don't do that. There's a much better way. The airdrop is much better than buying the coin. You work out the maths on it, it's like 5 times as good. There's a couple more layers than this, and I don't have time because I've been going over time. We're artificially forcing the price to go up. You can see you can read all about it at docs.hypertrend.xyz. There's a heap of stuff about it, all the technical details. So using trend, big returns. You make money by investing in the trend coin. As the number go up, tokenomics come into play. So your money invested in our hypertrend vaults will go up about 50% a year. It's never going to be that 100 to 1 moonshot, but this is. The trend token is. So you get both. You get paid passive income in USDC just for holding trend, and you're going to get a big fat airdrop worth several $1,000s. Here's how you get the airdrop, what makes you eligible for the airdrop. FinRev is completely bootstrapped. We're beholden to no one. There's no arsehole VCs. We've taken no investor money. It's all community built. All our owners are the people that you interact with in our groups every day. Like everyone's got a piece. It's us. What we're building is ambitious. We've got like half a dozen of some of the best devs in the world. We've got James, who's not cheap and incredible, and James has a team around him now. He's got a bunch of super math geeks behind him. Most crypto projects will make a deal with the devil and take the VC money. We didn't do that. We've been muddling along. It isn't because of some community first altruistic bullshit. It's because if we sell out to VCs are going to sell out on us, and they're going to fuck everyone. They've always fucked everyone. They're going to do it again. We all need to be in the same boat, rowing in the same direction if we're going to win. Who do I want to be side by side in the trench? I want some guy just like me who's got a life-changing win at the other side if he doesn't sell. And I'm putting my entire crypto net worth into it, liquidating all my bags, going straight into this. Everyone is actually. I'm not going to ask you to help me without making it worth your while. Everyone who invests in FinRev today gets a massive airdrop of trend when we launch. It's based on a point system. So you've gotten the hype airdrop, you'll be familiar as we're using a similar system. So real users are distributed points for taking actions. The action that matters more than all the other actions is depositing funds into the trend vaults. It's hard to gain. You just be a real user of the trend vaults. This is how you get the most amount of points. At token generation event, TGE, we distribute the trend airdrop across all our real users. This will be a massive amount. We're airdropping 32 million coins, which is 32% of the supply, $32 million. It launches at $100 million. It goes to the community. So you don't only get the money, you get the airdrop, trend tokens at TG. That TG is going to be Q1 next year. If you choose to hold, probably the end of Q1, if you choose to hold your trend tokens, not only do you get paid for being an owner As people outside of our community buy the trend token, it means your trend token price goes up, making you even richer. I mean, you can see what happened since we listed this thing. You know, don't go buy it now. The airdrop is a much better deal for you. But you can see that randoms just keep picking it up, and you know that's not a bad looking chart, like all things considered. So owning trend is like owning a real estate portfolio that pays you in USDC, and it grows about 50% every year. Until you decide to sell it all and fuck off, or just live off the attach a credit card to it and live off it. So I always wished there was a set and forget asset I could hold forever that would just spit out US dollars for me every month, so I could stop thinking about money and just live my life. Because I'm a good trader, but I don't particularly like it anymore. I've been doing it 20 years. You know, I'm ready to stop, honestly, and this is the vehicle for me to stop. This is something every single one of our employees want. It's Ian needs it. Thank fuck you got this today, man. If you're left to your own devices, you'd be fucked, son. Me too. This is why we're building it, because we need it. I need something that just pays me forever. If you'd like crypto to finally grant you the early retirement wealth you've been chasing, well, this is it. This is your opportunity. This is my goal for you. The same as my goal for myself is to do whatever you want, wherever you want, with whoever you want. It's just a tool to buy time and freedom and let compounding do the real work. So here's the deal. We've got two tiers of FinRev available for you today. FinRev Gold is just trend following, which we've talked about. It's $6,500 for 3 years, and you get a $6,500 airdrop. So you get your money back when we do the airdrop. FinRev Platinum is the blend of the 3 different algorithms that I showed you before with multiple accounts. So it's $9,500 for 3 years of fully automated trading. The multiple accounts is a big deal. No matter which tier you pick, as a special Black Friday promotion, we're going to give you $750 in USDT straight into your wallet to get you started. So remember, being a FinRev user guarantees you'll get maximum upside with the airdrop. You get $750, you get airdrop points. So for $6,500 for 3 years, you get 3 years of automated algorithmic trading. You get a VIP onboarding with one of our crypto trader coaches. You get all the stats and the dashboards that I showed you today. You get our double your money guarantee. If you aren't in profit after your first 12 months, we'll let you use it for free until you've doubled your money. You should book a call to get on board with the airdrop at finrev.trade/call. The 9,500 version is everything from gold, plus you can delay starting or pause at any time if you see some meme coin or whatever you want to ape into, and then pull it back out after you've won. We get 2 additional systems, which are both cross-sectional momentum and cross-sectional carry. These make things smoother and faster. The same double your money guarantee, but the big advantage is that you get to run multiple accounts. So you can run a DGen account at high leverage. You can run things at leverages that are not sensible to do. So you can run what we call a volatility target of 100, which means that if we get a good run in crypto, your account is going to be like 2,000% up in 3 months. So with FinRev Platinum, you get 3 accounts instead of 1 account. You can have a safe account. You can have an account for your children. You can have a DGen account. Everyone likes their DGen accounts. I love mine. You can get insane returns if you get the right spot in a DGen account. See, the DGen account came because our CTO turned $200 into like 20 grand doing this, and now everyone wants to do it. Don't do it with all your money. Just do it with 5-10% of your money, whatever. Book a trade, finrev.trade/call. Just one note about security. No one from our company can withdraw your funds from any exchange. It connects to your crypto exchange of choice through an API. That means no one has any access to your funds. Only you have access to withdraw or add more funds. So what are you really getting today? You're getting access to the rapid wealth building engine that fully automates massive returns with crypto. You join FinRev Gold or Platinum today, it builds it on autopilot for you. So you don't have to be watching the market like all day, every day. $1 million retirement is very realistic. It really is. if you have to stick with it for the long haul, plus you get $750 to get started. When you join FINRA today, you get to be part of this massive wealth generation event. It's going to be something special, guys. The hype around this is so real. Inside the hyperliquid community, talking to people who are influential in everyone loves this. It's an idea whose time has come. Yeah, book your call. Get the Black Friday thing. I'm going to hand you back over to Ian. And sorry for taking up so much of your time.
Hey, Scott, that was an absolutely awesome session today. Really crisp, clear. There are very, very few. We're obviously here to take any questions, but I think everything has really been mocked up, and yeah, really great stuff. Okay. Well, we've taken over 2 hours of people's time today.
Yeah, I'm sorry about that. I just rabbited on.
Hey,
By the way, James's thing was, how good was that?
Oh yeah, I mean that was what a way to start. There you go. There's a complete trading system, from
That people have made their living from for
down.
years and years and years, that all of our mates are using like today to trade money. It's like fucking great.
Mm. Yeah, people should check out his blog. Just Google Robot James. It's got some amazing content on there. Jim Jager says he's getting hungry. Yeah, me too. It's
Oh, we're hungry, boys. We're hungry. Hungry. All right, let's wrap this up. We're taking up too much of people's time. Thank you so much. All I can say about the Hypertrend token is that we've gone all in on it. I'll be an extremely poor man if it doesn't work out, and that's right and proper as it should be. All of us can be poor if we don't make it work. So I have to make it work, or I have to explain to my family that I've done fucked up, and I'm not going to do that. So I'm going to make it work.
Legitimately sleeping with the buffalo.
With the buffalo.
Right. All right, lovely. Thanks, everybody. Cheers, Scott.
See you, brother.
Ta-da.